In this example, we'll be doing exercise 12.3 that can be found in your textbook on page 566. We are going to show how to divide out partnership income in a variety of different ways. In the exercise, it tells us that we have two partners, Nicole Murphy and Ashley Drake, and they formed a partnership by investing $270,000 and $90,000 respectively. We need to determine their participation in this year's net income of $350,000 under each of the following independent assumptions. In Part A, it says there's no agreement concerning the division of net income. In Part B, it's going to be divided in the ratio of original capital investments. In Part C, there's going to be an interest at a rate of 5% allowed on the original investment, and the remainder to be divided in a ratio of 2:3. In Part D, we'll have salary allowances of $40,000 and $50,000 respectively, and then the balance will be divided equally. And in Part E, we have an allowance of interest at a rate of 5% on the original investment, salary allowances of $40,000 and $50,000 respectively, and then the remainder is to be divided equally. Again, remember that each one of those scenarios is independent from each other. In the first part, it says there is no agreement concerning division of net income. When there's no agreement, our net income is simply divided equally, meaning that out of the $350,000, they will each get half, or $175,000. When we add it across, we have to come back to the total net income amount. Again, we're trying to divide out the total $350,000 of net income. We are not trying to divide out the original investments made by the owners. In Part B, it says that we're going to divide out the net income in the ratio of original capital investments. The first thing that we need to do is to determine what that ratio is. They told us that in total we had $270,000 from Murphy and $90,000 from Drake. So the total value of the business is $360,000. We need to determine what fraction of that $360,000 was contributed by Murphy and what fraction was contributed by Drake. In order to do that, we simply take Murphy's initial capital investment of the $270,000 and divide it by the total value of the business, $360,000. That gives us 0.75 or 75%, which means that our ratio then is a 3:1. Because if we put in the $90,000 that was contributed by Drake, again divided by the $360,000, we get 0.25 or 25%. Remember, when we add together our ratios, we always have to get back to 1 or 100%. So for every 1/4 that Drake put in, Murphy put in 3 times as much. So our ratio then is 3:1. So we'll take $350,000 of net income and multiply it by 75%. And we'll take the $350,000 of net income and multiply it by 25%. Again, remember, in the total column, it always has to equal back to the full $350,000 of net income. In Part C, we're going to get an interest at a rate of 5% on each partner's original investment, and then the remainder will be divided in a ratio of 2:3. So we have an interest of 5%, and then a ratio of 2 to 3. When we have a list of items that is listed in the partnership agreement, we have to follow all the steps that are given in the order that they're given. So first, we have an interest of 5% on each partner's original capital investment. So for Murphy, she originally invested $270,000, and we are going to give her an interest of 5%. For Drake, she invested $90,000 and also will get an interest of 5%. So in step number 1, in total, if we add the two together, we have distributed $18,000 out of the $350,000 that we need to distribute. So we have a remainder left over, $350,000 minus what we've already distributed of that $18,000. We need to distribute another $332,000 in total in a ratio of 2 to 3. Again, a ratio is just a different way of expressing a fraction. So if we take the two numbers that are shown in the ratio, the 2 and the 3, and we add them together, we can now express our ratio as a fraction of 2/5 to 3/5, meaning that Murphy will receive 2/5 of the remainder and Drake will receive 3/5 of that remainder. So we will take the $332,000 and multiply it by 2/5 for Murphy, and we will take the $332,000 and multiply it by 3/5 for Drake. Again, when we add them together, we get back to the $332,000. In part 1, we gave them an interest. In part 2 of our partnership agreement, there was a ratio of 2 to 3. In total, we have now distributed the full net income of $350,000. For Part D, we are going to give salary allowances to each one of our partners of $40,000 and $50,000 respectively, and then any remaining balance will be divided equally. So we have a salary allowance of $40,000 to Murphy and $50,000 to Drake. So in step number 1 in Part B, we have now successfully distributed $90,000 of the $350,000 that we have in net income. They told us any remainder to be divided equally. We had $350,000. We just distributed $90,000, which means we have $260,000 left to distribute. And again, we're going to distribute it equally. So we take our total and we divide it in half for each one of our partners. So in total, Murphy will get $170,000, and in total, Drake will receive $180,000, and we just successfully distributed $350,000 in net income. For Part E, we are going to give an allowance of interest at a rate of 5% on the original investment. then salary allowances of $40,000 and $50,000 respectively, and then the remainder will be divided equally. So we'll start with an interest of 5%. Again, it's based on the beginning capital balances. So $270,000 is Murphy's initial capital balance, and we multiply it by 5%. And for Drake, capital balance at the beginning was $90,000, and we multiply it by 5%. We add it across to see how much we've distributed thus far. So far, we've distributed $18,000. We now have a salary allowance that we're going to give. $40,000 to Murphy and $50,000 to Drake. So in total, in step 2 of part E, we've distributed $90,000. The final step says any remaining balance should be distributed equally. We had $350,000 to distribute. We distributed $18,000 by giving them a 5% interest on their capital balance. And we've distributed $90,000 by giving each one a salary allowance. That only leaves us with a remainder of $242,000. And it says to be divided equally. So we take our total and divide it in half. So that means for Murphy in part E, she would receive $174,500. Drake would receive $175,500. And in total, we have successfully distributed the $350,000 in net income.